Hi, this is Parag Sam. Welcome to this episode of the Living and Working Abroad show, where we're looking at a variation on the theme of a good way to die. A good way to die, in my opinion, is that you planned ahead and your estate is organised for your family, for your widow, your spouse, your children, to minimise the concerns that they've had. That needs planning ahead. That means putting the right will in place, the right instructions. It means making gifts to avoid inheritance tax or organising succession plans in arrangements like JCB have done this week to organise. They've anointed the successor to the 80-year-old chairman who it's a family business, and the 80-year-old chairman has sort of designated his son to take over that business. That is a good way to die. He's not going to die today. He could well live to 100 or beyond. You want to live a long and happy life. You don't know when your time is up, whether it's by ill health or accident or circumstance. A good way to die is to plan ahead and make sure that you avoid the cost and delay of probate and the cost and expense of inheritance taxes and capital gains taxes and legal fees, extracting capital assets and property and investments from overseas jurisdictions. So let's have a look at how it's going in the UK. Inheritance tax has had a fixed personal allowance for well over 10 years now. It's stuck at 325,000 per person. It's not applied until the second death. But over the last 15 years, property prices, investment portfolios have all gone up, gone up, gone up, gone up. So it's bringing more and more of your assets into inheritance tax assessment at 40%, even though it's only paid on second death. But now, this Labour government committed to taxing and penalising people for enterprise and investment and wealth creation have added your pension pot to the inheritance tax portal. Before, your inheritance tax pot, your pension pot, was not subject to inheritance tax, so a widow, spouse, or family children could benefit from that without any additional tax, and at most a sort of basic rate tax. But now inheritance tax applies 40%. Thank you for that. Okay, good for the government, not good for you. So a number of different ways to do that. There are some high risk ways and some low risk ways. One of the topics that people look at for high net worth people is creating private unlimited companies which have got no reporting requirements to Companies House, so can be creating gifts, a way of gifting assets to beneficiaries discreetly in the UK. I would put that as a high risk strategy. Remember, with inheritance tax, there's potentially a lifetime 20% inheritance tax liability on any gifts. Now, where does that come from? It comes from the fact that if you try to plan to give your estate away without paying inheritance tax when you die, the government want to make it as hard as possible for you. So they give you waiting periods, time has to elapse, maybe 7 years, maybe 11 years, or they will apply a 20% tax on assessment, the transfer of the capital asset. So how can we get around that? At ProAct, we're very passionate about protecting a family's wealth, their business, their property, their investments, from the cost and delay of probate and the cost and delay of inheritance tax. If you've got an overseas probate, it's very easy for you to get a 5% charge to sell real estate, a 10% charge to sell to manage a probate administration, plus in addition to that, capital gains taxes on the disposal of the assets. So even though there may be no inheritance tax in another country, the fixed cost could still be 20, 25, 30%. So how can you manage that? Well, the, the Glasgow Foundation is a company built on a trust. The Rolex Corporation is a company, is a not-for-profit company. Nobody makes profit, but if you don't own anything when you die, no probate administration is needed. No inheritance tax assessment is applied. So if you can create a business trust or family trust to hold your assets, then no probate is required and no inheritance tax assessment is made. It could be made when you make the gift, and that's where know-how and expertise from PROAC can come in to protect your wealth, your assets. You as an individual don't need to live in a country like Cyprus to do this arrangement. Cyprus is based upon English law, so trusts apply, and if you're an overseas creator of an international trust, there is no taxes applied, okay, in Cyprus on your overseas asset. If you're selling property in the UK, you cannot avoid the fixed property rental income, the fixed capital gains. You can't avoid that. I can't help you with that. All we can do is write it off now and get it tax protected going forward. But if once you've got the assets within the trust, there is no liability for any additional taxes. So Cyprus has got no inheritance tax, effectively no capital gains tax on an international trust. And the trust doesn't die with you. So it's not about having to transfer property. It's not about having to transfer business shares. The trust can own the shares. The trust can own the property. You can live in the property with reservation, question mark there, come to that later. You can live in the property, you can enjoy the property, your family can live in the property, but the most important thing is that inheritance tax assessment doesn't apply. So down the generation, the family can enjoy the asset, whether it's a fancy old MG or Ferrari car, a business shares with dividends income being paid, or overseas property as a holiday home. All those things are available to you if you've got that availability. Creating the trust is relatively simple, and PROAC can manage that. You've got to have it managed and based in Cyprus. You don't need to be here. But if you've got a management of a business trust in Cyprus, then you can then enjoy Cyprus corporation tax rates of 15%. That's a 10% saving on UK corporation tax rates, plus no inheritance tax assessment on the assets that are built up overseas. So retain your profit in the overseas company and no further liability going forward. Within a trust, there's no reporting of that liability. If you're making a gift without a reservation, but you're making a gift of property assets or investments, and you want it to be potentially inheritance tax free, but you don't want the minor children or the children to benefit from it too early or before you're gone, then again, a trust works for that, because it means that you can hold the assets while they go through the lifestyle. But when you come to when you do die, the good thing is that the trust is in place. There's no probate administration. The instructions, your will instructions, are contained within the trust, and there's no inheritance tax assessment on that either. And so within 2 weeks, everything is handed over to the new trustees who will manage your estate. The Duke of Westminster is reputed to be one of the richest men in Britain. He's not. He is a beneficiary of a family trust. He is a trustee of that family trust that descends from the Duke of Marlborough, who won the Battle of Waterloo and was bestowed upon this wealth by a grateful king and nation. And that is it. It passes down from generation to generation. He can enjoy the assets. He can benefit from that. He can have the work as a trustee in that, but without the inheritance tax assessment of 40% chipping away every time you want to make a movement. So if you look ahead, if you plan ahead with a will, is the first step for sure. But if you make a family trust or a family um, a business trust, then you can plan ahead and have all these things covered for years in the future. Not necessarily with a pension. Now, the interesting thing, a pension is already a type of trust fund anyway, but it's under very specific UK laws and it's tied and fixed and taxed as a fund in the UK. So if you want to get your pension fund out of the UK, then what you have to do is what 460,000 people did in the last tax year, is withdraw their whole pension pot in one single lump sum. Now, if you've got a small amount of lump sum, that's no bad thing. If you get a 25% tax-free lump sum, that's no bad thing. Get away and do that. But if you want to get away from inheritance tax, your problem is that drawing the money as a UK taxpayer, the individual is liable to up to 45% income tax. If you transfer it to an offshore pension fund, where the UK would lose control, even if they agreed, got the management costs, the expense costs of doing that, and a 25% tax that HMRC can apply to your fund when transferring it overseas. The alternative way is relocate as an individual to become a tax resident of Cyprus, which would then protect you from, start the road to protecting you from inheritance taxes and future income taxes and capital gains taxes in the UK. But also, you can start planning your pension moves. If you draw £1 million out of your pension as a tax resident in Cyprus as an individual, even though your pension fund is in the UK, you as an individual can draw £1 million, pay 5% tax, flat rate, done, dusted, cash in your hands. If it's 10 million, it's 5% tax. If it's 50 million, it's 5% tax. So no matter how large your pension fund is, a flat rate 5% tax pays an individual. So by structuring it that way, you can get that free cash back in your hands. Now, it's still going to be liable for inheritance tax, but then you can start doing something a bit different. You can't get it away from inheritance tax in the pension fund, but in your cash hands, you can gift it to children, you can gift it to charities, you can do all sorts of arrangements to protect that, or put it into a family trust, an investment pot, so it creates wealth income 300 years later after the Battle of Waterloo. That family trust is still invested in property, shares, investments, and generating income and wealth for the family. Look after your family, not just when you die, but 100, 200 years' time. That is a good way to die. That is a good way to die. Doing nothing is not a good way to die. Waiting until you're about to die is not a good way to die. Plan ahead to make the best advantage of tax savings that you can get. You can gift from the UK anyway without inheritance tax. You don't need to be in Cyprus as an individual to start a family trust or a business trust, but we could then progressively develop that for you going forward that protects you from inheritance, wills, probate, and liabilities. And how long does it take when somebody dies to hand over the assets, the property, the investments, the income? 2 weeks normally. 2 weeks after getting a death certificate, everything is transferred over. That is the benefit of a business trust or a family trust to you and your family. And that is a good way to die. If you want to take up this recommendation, if you want to take up this idea, we offer a free review to anybody to consider that. So contact us at poetpartnership.com and we can guide you on your options in terms of where you're coming from, where you want to go to. You don't have to go to Cyprus. There's lots of other ways that we can do it. But think outside the box and manage uh, your future and take care of your family when you die and 200 years later. Contact us at proactpartnership.com.